In 2026, a household earning $120,000 a year in the United States will lose a meaningful share of it to income tax before they ever see it. A family holding $500 million in assets, passed down through 3 generations, can legally arrange their affairs so that a significant portion of that wealth is never touched by federal income tax, capital gains tax, or estate tax at all. Not through fraud, not through offshore secrecy, not through anything a prosecutor could touch. Through paperwork. Old money doesn't out-earn the tax code. It outstructures it. And the tools it uses aren't secret. They have names. They have IRS code sections. They're taught in law schools. The only thing separating a $50,000 a year household from a $50 million family office isn't access to a secret system. It's access to the people who know how to use the system that already exists for everyone. Today we're opening that system up. No moralizing, no envy, just mechanism. By the end of this video, you'll understand exactly how a dynasty holds on to its wealth across generations, legally, quietly, and almost invisibly. If you want the full architecture of how old money actually works, not the aesthetic, the mechanics, subscribe now. This channel breaks down the real infrastructure behind generational wealth every week. The first principle: income is for people who work. Here is the first thing you need to unlearn. The U.S. tax code, and most Western tax codes, were never built as a flat wall. They were built as a maze with many doors, and the height of the wall depends entirely on which door you use. The tax code taxes labor, wages, salaries, bonuses at the highest rates, up to 37% federally in the United States. This is the door almost every employee walks through. But the tax code treats long-term capital gains, profit from assets held more than a year, completely differently. Long-term capital gains are taxed at 0%, 15%, or 20%, depending on taxable income and filing status. That's roughly half the top rate on ordinary income, sometimes less. Old money's first and most fundamental move is structural. It minimizes the amount of its economic life that shows up as income in the first place, and maximizes the amount that shows up as asset appreciation instead. A founder of a company doesn't take a $10 million salary. They take a modest salary, sometimes shockingly modest, and let the value of their equity grow untaxed on paper. A landed family doesn't sell the farm every generation to fund lifestyle. They let the land appreciate, borrow against it, and never trigger the sale that would create a taxable event. This single reframe, income is a trap, appreciation is a vehicle, underlies almost everything else in this video. Buy, borrow, die. The strategy that never sells. This next strategy has become so well documented in financial and legal circles that it now has a nickname: buy, borrow, die. Here's how it works in 3 steps. Step 1, buy. A wealthy individual buys appreciating assets, stock, real estate, a business stake. They hold rather than sell. Step 2, borrow. Instead of selling appreciated assets to fund a lifestyle, a yacht, a second home, a philanthropic gift, they take out a loan against those assets, using the assets as collateral. Banks are eager to do this for high net worth clients because the loans are secured and low risk. Here's the critical detail. Loan proceeds are not income. You do not pay tax on money you borrow. So, a founder holding $2 billion in company stock can borrow $50 million against it at a low interest rate, spend that $50 million on anything they like, and owe 0 income tax and zero capital gains tax on that money, because legally nothing was ever sold. Step 3. Die. This is the step most people have never heard explained. When the asset holder eventually passes away, their heirs inherit the stock, the real estate, the business, not at the original purchase price, but at its fair market value on the date of death. This is called the step-up in basis. Here's a real-world style example. John and Mary bought shares of stock in 2005 for $50,000. By the time John dies in 2026, those shares are worth $500,000. Without a step-up, selling the shares would trigger a taxable gain of $450,000. With a step-up, the new basis becomes $500,000, and the capital gains tax owed on an immediate sale drops to zero. $450,000 of gain. Erased, not evaded, erased by law. This is not a fringe tactic. According to the Joint Committee on Taxation, stepped-up basis will account for $72.5 billion in foregone federal revenue in 2026 alone, roughly a quarter of all revenue the government would otherwise collect from capital gains taxes. And the majority of that benefit, 56%, in the most recent year studied, flows to the wealthiest fifth of estates. The debt from the borrow step, it's typically settled by the estate using some of the very assets that just received a fresh tax-free basis, or simply carried forward and refinanced by the next generation, who repeats the cycle. Buy, borrow, die. Repeat for as many generations as the family can maintain discipline. This is exactly the kind of mechanism-first breakdown this channel exists for. If you're finding this valuable, drop a comment with the word structure. It tells me you want more of these deep dives, and I read every one. The married couple's secret weapon. The double step-up. The step-up in basis gets even more powerful for married couples, and this is where geography starts to matter enormously. In the 9 community property states, California, Texas, Arizona, Nevada, Washington, Idaho, Louisiana, New Mexico, and Wisconsin, married couples can hold assets as community property. When one spouse dies, something remarkable happens. The entire asset, both the deceased spouse's half and the surviving spouse's half, receives a step-up to current fair market value, not just the half that belonged to the person who died. Compare that to a common law state like New York or Massachusetts, where a surviving spouse only receives a step-up in basis on the deceased partner's portion of ownership. Same marriage, same assets, dramatically different tax outcome, purely based on which state the couple happened to live in. Old money families have noticed this. 5 common law states now allow what's called a community property trust, so couples can access the double step-up even outside the traditional 9 community property states. Alaska, Florida, Kentucky, South Dakota, and Tennessee all offer this option, with Florida's version, enacted in 2021, becoming particularly popular. There's also a more sophisticated tool available to sophisticated families, the QTIP Trust, Qualified Terminable Interest Property. One spouse transfers assets into a trust that benefits both spouses during the first spouse's lifetime. Because the trust is structured to be included in the first spouse's estate, it receives a basis step-up at the first death. The executor then makes a special election, so the same trust assets are included in the surviving spouse's estate as well, triggering a second step-up at the second death. 2 step-ups, 2 resets to 0. This is called the double basis step-up, and it's one of the most quietly powerful tools in modern estate planning. precisely because it requires no drama, no offshore accounts, and no aggressive tax positions. Just a correctly drafted trust document, filed years in advance. One more detail that trips up ordinary investors and saves old money families millions. The step-up only applies to inherited assets, not gifted ones. If grandchildren inherit a stock portfolio, they receive it at fair market value on the date of death. But if that same portfolio is gifted to them while the grandparent is still alive, the grandchildren instead inherit the original much lower cost basis and a potentially enormous capital gains bill waiting to happen the moment they sell. This is why estate planners have a simple, almost religious mantra: bequeath, don't gift. Appreciated assets are held until death, not given away during life. Cash, by contrast, is often gifted freely during life because cash has no embedded gain to step up in the first place. Freezing the clock. How GRATs move. Growth out of the estate. So far, we've talked about what happens to assets that stay in an estate until death. But there's an entirely different family of tools designed to move future growth out of an estate while the owner is still alive, legally and often at close to zero tax cost. The flagship tool here is the Grantor Retained Annuity Trust, or GRAT. Here's the mechanism, simplified. A wealthy individual, usually someone who owns an asset they expect to grow quickly, like pre-IPO stock, a stake in a private company, or a concentrated position in a hot sector, transfers that asset into an irrevocable trust for a fixed term, say 2 to 10 years. In exchange, they receive annuity payments back from the trust over that term, payments calculated using an IRS-published interest rate called the Section 7520 rate, sometimes nicknamed the hurdle rate. As of early 2026, this rate has hovered in the range of roughly 4.6% to 4.8%. Here's the elegant part. If the asset inside the GRAT grows faster than that hurdle rate, which for a hot stock or a thriving business is a very achievable bar, the excess growth passes to the grantor's beneficiaries at the end of the trust term with little or no gift tax owed. The grantor gets their original contribution back, dollar for dollar via the annuity payments, and all the upside, the part that would have been taxed as part of a growing estate, skips out to the next generation almost tax-free. These are sometimes structured as zeroed-out GRATs. The trust is designed so the present value of the annuity payments essentially equals the value of the assets transferred in, meaning there is little to no taxable gift at all when the trust is created. If the underlying asset performs well, the family wins enormous value transfer for close to zero gift tax cost. If the asset underperforms, the strategy simply doesn't produce a benefit, but it doesn't produce a penalty either, beyond the legal fees to set it up. There is real risk here worth mentioning honestly. GRATs are irrevocable, meaning the grantor can't change the terms once it's running. And if the grantor dies before the trust term ends, the appreciated assets can be pulled back into their taxable estate, erasing the benefit. This is why families with access to good actuarial and legal advice often run short-term, rolling GRATs, 2 years, then a new one, then another, to keep mortality risk low and continually reset the hurdle rate to current market conditions. One more nuance that separates casual planning from dynasty-level planning. GRATs generally cannot be used to skip a generation and go straight to grandchildren without triggering the generation skipping transfer tax, because the GST exemption is difficult to apply to a remainder interest that starts out valued near zero. So sophisticated families layer strategies. A GRAT moves growth to the children's generation, and separate dynasty trust structures, funded differently, are used to reach grandchildren and beyond. Which brings us to the next layer of the architecture. If terms like generation-skipping transfer tax sound intimidating, don't worry. That's exactly what the next section untangles. Make sure you're subscribed so this doesn't get lost in your feed, because we're about to go multi-generational. The Dynasty Trust, building a vault that outlives everyone. If a GRAT is about moving one generation's worth of growth, the Dynasty Trust is about building something that never has to move again. A Dynasty Trust is simply a trust designed to last for many generations, or indefinitely, making payments to beneficiaries along the way, while keeping the bulk of the underlying assets in the trust, untouched by estate taxes generation after generation. Here's why this matters so much. Without a structure like this, wealth gets taxed at every single transfer point. Grandfather to father, estate tax event. Father to son, another estate tax event. Every generational handoff is a toll booth. A well-built dynasty trust removes most of those toll booths entirely, because the assets technically never belong to any individual family member after the initial contribution. They belong to the trust, which doesn't die. The key legal ingredient that makes this possible is something called the Generation Skipping Transfer Tax Exemption, or GST exemption. Ordinarily, if you tried to leave assets directly to your grandchildren instead of your children, the tax code would apply an additional layer of tax specifically designed to stop people from skipping a taxable generation. But dynasty trusts are structured to apply available GST exemptions strategically at the time the trust is initially funded, effectively immunizing the growth of those assets from generation skipping tax for as long as the trust exists, which, in states that allow it, can be forever. And that forever detail matters more than most people realize. Historically, a legal doctrine called the rule against perpetuities prevented trusts from lasting indefinitely. Eventually, the law required the assets to be distributed outright. But many U.S. states have now abolished that rule entirely, meaning dynasty trusts in those states can legally last forever. South Dakota, Nevada, Delaware, and Alaska have become magnets for exactly this reason. Families with no other connection to those states will still set up dynasty trusts there purely to take advantage of favorable trust law. The scale of this is genuinely staggering. Some estimates suggest that as much as $13 trillion, close to a quarter of the total wealth held by the top 1% of American households, currently sits inside trust structures like these. It's worth pausing here to underline the channel's editorial stance. This is not a hidden conspiracy. It's public law, written into state trust codes that anyone can read, drafted by legislatures competing openly for trust business, the same way states compete for corporate headquarters. The secret is simply that most people never meet a lawyer who explains it to them, because most people don't have $10 million in assets that would justify the setup cost. The 2026 shift, why the rules of the game just changed. Here's where this story gets genuinely current and genuinely important for anyone watching this in real time. For years, estate planners operated in a state of uncertainty because the federal estate and gift tax exemption, the amount a person can pass on before facing federal estate tax at all, was scheduled to be cut roughly in half at the end of 2025 under prior law. That didn't happen. Instead, new legislation known as the One Big Beautiful Bill Act, or OBBBA, raised the federal estate tax exemption to approximately $15 million per individual starting in 2026, doubling to $30 million for a married couple. The practical effect of this is enormous, with less than 1% of the U.S. population now subject to federal estate tax at all. The center of gravity in estate planning has shifted. For decades, the primary goal of estate planning for wealthy families was minimizing estate tax. Today, for the vast majority of even quite wealthy families, that tax simply doesn't apply to them anymore. So, what replaces it as the main event? Capital gains tax. With estate taxes now largely irrelevant for all but the ultra-wealthy, maximizing the step-up in basis has become the single most important move in estate planning, which is exactly why we open this video with that mechanism. There's a fascinating side effect of this shift worth mentioning. Some families who set up complex trust structures decades ago, structures built specifically to minimize an estate tax that might not even apply to them anymore, are now going back to their attorneys to unwind or restructure those old plans. Techniques designed years ago around minimizing federal estate taxes may have completely ignored basis step-up considerations, and the capital gains tax savings from a plan focused on the step-up can now outweigh the estate tax savings those old structures were built for. Even the ultra-wealthy have to keep updating their paperwork as the rules shift beneath them. This is arguably the most important takeaway of this entire video. Old money's advantage isn't a single trick. It's an ongoing, professionally managed relationship with a constantly changing rulebook. A family office doesn't set up a trust once and walk away. It reviews the structure every time the law changes, the way a shipping company reroutes around a closed canal. The quiet tools, gifting, charity, and everyday discipline. Not every tool in this playbook requires a trust attorney on retainer. Some of the most effective wealth preservation habits are almost boringly simple. They just require decades of consistency. The annual gift tax exclusion. In 2026, any individual can gift up to $19,000 to as many different people as they like, completely free of gift tax, and a married couple can each give that amount to the same person, doubling it. A family with 4 children and 8 grandchildren, giving the maximum to each person every single year, can move well over $1 million out of their estate annually, with zero paperwork beyond a bank transfer and zero tax consequence. Do that for 20 years, and you've quietly transferred tens of millions of dollars without ever touching the formal gift tax exemption at all. Charitable strategies. Wealthy families frequently donate appreciated stock rather than cash. This allows a tax deduction for the full fair market value of the donation, typically up to 30% of adjusted gross income when donating securities, and any unused deduction can be carried forward for up to 5 additional years. The family gets a deduction, the charity gets the full value of the stock, and, critically, nobody ever pays capital gains tax on the appreciation because the stock was donated, not sold. Charitable remainder trusts take this even further. These trusts are structurally tax-exempt, meaning they can sell appreciated assets inside the trust without paying capital gains tax at all, while still providing an income stream to the family for a period of years, with a charitable deduction taken up front for the present value of what will eventually go to charity. None of these tools are exotic. They're available to anyone with an accountant willing to explain them. The difference is that old money families treat these not as one-time tax season tactics, but as a decades-long disciplined system, reviewed annually, adjusted as laws change, and passed down not just as wealth, but as institutional knowledge about how to keep the wealth. This is the part most content about old money skips entirely, the aesthetic without the architecture. If you want the mechanism-first version of this story every week, hit subscribe and turn on notifications so you don't miss the companion video on how family offices actually structure themselves around these tools. The actual lesson. Here's the uncomfortable truth underneath all of this. None of what we covered today is illegal, hidden, or even particularly complicated once explained. A step up in basis is one sentence in the tax code. A GRAT is a trust with an annuity attached. A dynasty trust is just a trust that doesn't have an expiration date written into it. What separates a family that keeps its wealth for 200 years from a family that loses it within 2 generations isn't secrecy. It's structure, discipline, and professional continuity. The willingness to pay a lawyer today for a benefit a grandchild won't see for 40 years. Old money doesn't out-earn the tax code, it outplans it. And now, so do you. At least in understanding. If this opened your eyes to how the real architecture of generational wealth works, subscribe to Old Money Opulence. New investigations into the mechanics behind old money drop every week. And if you want to go deeper right now, watch the companion video linked on screen, and I will see you in the next.